On December 22nd, 2025, something significant just happened in crypto derivatives markets. For the first time since November 2023, Binance overtook CME as the largest Bitcoin derivative market venue by open interest. This is not just a market milestone, it's a signal about where institutional money is flowing, how basis trade economy has shifted, and the fundamental difference between how institutions and retail trades access Bitcoin exposure. If you're managing serious capital in crypto, understanding why this happened matters more than headline itself. I'm Saleh. In this channel covers macro crypto analysis for serious investors. Today we are discussing difference between CME, Bitcoin futures and perpetual swaps, not as a trading products but as an indicators of institutional versus retail market positioning. Here is the thesis. CME futures are designed for institutions executing basic trades and regulated hedge narratives. Perpetual swaps are built for traders making directional bet with leverage. The recent shift in open interest from CME to Binance tell us basis trade probability has collapsed, institutional arbitrage has unwound, and retail directional speculation is now driving more derivative volume than institutional structural products. We will break down how each instruments work, why institutions prefer futures, why retail dominates perps, and what December 2025 data tells us about the current market structure. So what are CME Bitcoin futures? The first, CME Bitcoin futures. These are standardized cash-settled derivative contracts traded on Chicago Mercantile Exchange. They were launched in December 2017 and regulated by CFTC. Structure. The standard Bitcoin futures represent 5 BTC. There are also micro Bitcoin futures at 0.1 BTC per contract, designed for small institutional positioning and sophisticated retail investors. Expiration and settlement. CME futures have fixed expiration dates. Monthly contract expire every last Friday of each month. Quarterly contract expire in March, June, September and December. At expiration, contracts cash settle to the CME CF Bitcoin reference rate published at 4 p.m. London time. This is crucial. There is no physical delivery of Bitcoin. It's a pure cash settlement based on a regulatory reference rate aggregated from 4 major exchanges: Bitstamp, Coinbase, IT-Bit and Kraken. Margin requirements. As of December 2025, the maintenance margin for standard Bitcoin futures is approximately 100k to 115k per contract, depending on the volatility. For micro Bitcoin contract, it's around 2000 to 2500. These are the traditional margin, not the leveraged margin you see in the crypto exchanges. CME use span margin technology, which calculate risk across your entire portfolio. This means institutions who holding spot Bitcoin ETF and short future position can get a significant margin offsets. Who uses CME futures? Institutional players, hedge fund executing cash and carry trades, family offices hedging spot Bitcoin holdings, pension funds gaining regulatory exposure, corporate treasuries managing Bitcoin balance sheet risk. The CME provide what institutions require: regulatory clarity, CFTC oversight, no counterparty risk through CME clearing, and ability to integrate Bitcoin exposure into existing future portfolios alongside equities, commodities, and fixed incomes. Now, what are perpetual swaps? These are the derivative contracts that never expires. These were invented by BitMEX in 2016 and are now dominant crypto derivative product globally. No expiration. Unlike CME futures, perpetual swaps have no settlement date. You can hold positions indefinitely. There is no need to roll contract, no expiration driven volatility, no basis convergence at settlement. Funding rate mechanism. To keep the perpetual swap price anchored to the spot price without expiration forcing convergence, exchanges use funding rates. This is the payment exchanged between long and short positions holders every 8 hours. Here is how it works. If perpetual swap is trading above spot price, the funding rate is positive. Longs pay shorts. This incentivizes long positions and encourages shorts, pushes the perp price down towards spot. If perpetual swap is trading below the spot, funding rate is negative. Shorts pay longs. This incentivizes long positions, pushing the price up. Funding rates typically range from minus 0.1% to 0.1% per 8-hour period, which annualized to minus 30% to plus 30% per year in extreme markets. In normalized conditions, Bitcoin's funding rate hover around plus 0.01% per 8 hours, about 10% annualized. When market is bullish and everyone is long, you are paying to hold the long position. When the market are bearish and shorts dominate, shorts pay long. This is peer-to-peer. The exchange doesn't take a cut of funding. Leverage. This is where perpetual swaps diverge radically from CME futures. Binance offers up to 125x leverage. Bybit offers 100x. OKX offers 100x. That means within $1,000 you can control $125k worth of Bitcoin exposure in Binance. CME margins represents 10 to 15% of notional value. Perpetual swaps margin can be as low as 0.8% of the notional value at 125x leverage. This is not institutional risk management. This is the retail speculation infrastructure. Who uses perpetual swaps? Retail traders making directional bets. Hedge funds running high frequency strategies. Arbitragers capturing funding rate. But overwhelmingly, perpetual swap volume is retail driven directional speculation. Binance, OKX, Deribit, these are the venues. Unregulated or offshore regulated. No CFTC oversight. Counterparty risk exists, though major exchanges have strong track records. But risk profile is fundamentally different from CME. The key differences. Let's crystallize the differences. Expiration. CME futures expire monthly or quarterly. Perpetual swaps never expire. Settlement. CME cash settles to a regulated reference rate. Perpetual swaps mark to market continuously with no settlement event. Funding. CME futures have no funding rate. Instead, there is a basis spread between futures and spot that converges at expiration. Perpetual swaps have funding payment at every 8 hours to maintain the price parity. Leverage. CME offer margin-based leverage of roughly 8 to 10x for standard contracts. Perpetual swaps offer 100x to 125x leverage. Regulation. CME is CFTC regulated, US based, full regulatory oversight. Perpetual swaps are predominantly offshore or slightly regulated. Counterparty risk. CME clearing guaranteeing all trades. Zero counterparty risk. Perpetuals have the exchange counterparty risk. If Binance go down, your position is at risk. Although major exchanges are generally robust. Margin offsets. CME allows portfolio margining across all asset classes. You can offset Bitcoin futures against equity index futures and treasury commodities. Perpetual swap margin is isolated to crypto positions on that specific exchange. Tax treatment. In the US, CME futures are Section 1256 contracts, 60% long term, 40% short term, capital gain treatment regardless of holding period. Perpetual swaps are taxed as ordinary gains with no preferential treatment for US traders. This isn't just product difference, it's a philosophical divide. CME futures are designed for regulated institutions. Perpetual swaps are designed for global retail speculation. The December 2025 shift. Now the December 2025 data and why it matters. As of December 22nd, Binance hold 125k BTC in open interest. That's $11.2 billion notional. CME hold 123k BTC, $11 billion notional. Binance is now the largest Bitcoin derivatives venue right now. This is first time CME has lost the top spot since November 2023. Let me give you a context. CME had been the dominant venue following the launch of 4 Bitcoin ETFs in January 2024. Open interest peaked 200k BTC in late 2024 as Bitcoin approached 100k in post-Trump election. CME started 2025 at 175k BTC. Over the course of 2025, CME open interest declined 30% from 175k to 123k BTC. Binance open interest remained stable around 125k BTC throughout the year. Why does this happen? Basis rate compression. In late 2024, the annualized basis rate between CME futures and spot Bitcoin was around 15%. This is the premium futures trade over spot. It represents the cost of leverage, the time value, and arbitrage opportunity. The basis trade work like this: buy spot Bitcoin, sell CME futures, capture the basis spread. At expiration, futures converge to spot. You close both positions and you locked in 15% annualized return with market neutral exposure. Institutional capital flooded into this trade in late 2024 and early 2025. Hedge funds, prop desks, family offices, everyone was running cash and carry. But as more capital entered, the basis compressed. By December 2025, the CME base rate is approximately 5% annualized. That's 67% decline in profitability. For many institutions, 5% doesn't justify the capital allocation, perpetual overhead, and margin requirements. So they unwound. As institutions exited, CME open interest dropped. Binance open interest stayed flat because retail traders aren't running the basis trades. They are making directional bets. Long Bitcoin if bullish, short if bearish. Funding rates don't deter them the way compressed basis deters the institutional arbitrage. This tells us institutional structured product demand is waning, retail directional speculation is stable, the market is less efficient, arbitrage opportunity has compressed, but retail's participation in leveraged derivatives hasn't declined. What does this mean for how you think about Bitcoin exposure? Implication 1. Market efficiency has declined. When basis trade compressed and institutional arbitrage exists, price discrepancies between spot and future persist longer. The market is less efficient. For sophisticated traders, this means arbitrage opportunities may appear sporadically, but they are smaller and short-lived. Implication 2. Retail leverage dominates derivative volume. Binance holding more open interest than CME means retail directional bets now drive more derivative volume than institutional hedging. This increases volatility, sensitivity to retail sentiment, social media narratives, and leveraged liquidation cascades. When Bitcoin dropped 5%, it's not institutional basis unwinding, it's leveraged retail longs getting liquidated on Binance, Bybit, or OKX. That amplifies price moves in both directions. Implication 3. Institutional crypto exposure is now shifting to spot Bitcoin ETFs. If institutions are running basis trades on CME futures, where the institutional money will go? Yeah, exactly, spot Bitcoin ETFs. BlackRock's IBIT reached $500 billion in asset under management in 228 days. Fidelity's FBTC holds over $200 billion. Institutional ownership surged to 24% in 2025, while retail participation declined 66%. Institutions are now buying spot Bitcoin ETFs through regulated ETF wrappers instead of executing future-based structured products. This is the fundamental shift in how institutional capital access Bitcoin. Implication 4. Basis trade may return when rates rises. The 5% basis isn't permanent. If volatility increases, if regulatory clarity reduces arbitrage capital, or if spot ETF inflow surge and creates supply constraints that can widen the gains again. In Q1 2026, if basis rates returns to 10 to 12% annualized, institutional capital will re-enter CME futures. Open interest will rebound. But for now, the trade is in the implication 4. Perpetual swaps are retail's primary exposure. For retail traders, perpetual swaps are the access point. If you are trading Bitcoin derivatives with a $5,000 account, you are not on CME, you are on Binance or Bybit. High leverage, 24/7 trading, no expiration to manage. But understand the risk. 100x leverage means 1% move liquidate you. Funding rate eat into profitability. Exchange counterparty risk exists. This isn't investing, it's a high risk speculation. Bottom line, CME futures and perpetual swaps are not just different products, they represent different market participants with different risk profiles, different regulatory frameworks, and different motivations. CME futures are institutional infrastructure for regulated hedging and arbitrage. Perpetual swaps are retail infrastructure for leveraged directional speculation. The December 2025 shift, Binance overtaken CME, tell us basis trade economics collapsed, institutional arbitrage unbounded, and the retail leverage remains the dominant force in crypto.